Buenos dias. I hope everybody's having a great day. And I hope you guys didn't do anything silly yesterday. Panic when you saw the red. Oh my gosh, Cardano's down. I was actually about a nickel away from adding to my Cardano position because I did sell a little bit at $1.36, and I put it into Bitcoin at 43K. Oh no, hold on. It says we're having trouble streaming to the destinations. So I guess it's not going to. Well, I guess if you're on Theta, you're screwed. Sorry. Sorry. Hold on. So let me try to do some magic here. Let me tell the people at Theta, for whatever reason, it isn't streaming to Theta. Jump on YouTube. I'm sure no one wants to hear that. Okay, let me do something real quick. I'm going to get them a link just so that I'm not a total douche. I don't want to be a total douche. I'll be a 3/4 douche, but not a total douche. All right, let me see. Get shareable link. See if we can do this. Boop. Oh, it won't let me. It won't. Let me see. There. So that's the link. If you're on, sorry, Theta people. It is what it is. It's a busy day. We got packs going out. We're talking about Treasury securities. You're going to understand the whole Treasuries market better than most people that work at the Fed by the end of today. And we're going to hopefully get a pack. And I even did some sketchpad stuff. I'm going to keep my profanity to a minimum because I think we did a lot of that yesterday. We did so much profanity. We rule at profanity. And I would say that the people that were disenfranchised had it coming. Sorry for your luck. Okay. Let me say hello on, let's see, this is YouTube. It's Sylvia, Jimmy James, Scott, Patsy, JJ, Scorpion, P. Kelly, Getting Money, Michael Murphy, Joe Fernandez, buenos dias, ¿cómo estás? Over here on the Clubhouse, where, let's face it, anybody that can talk for 15 minutes sounds like an expert. There's all sorts of dummies that have thousands of followers. Do not be enticed by follower count on Clubhouse. You will be led in the wrong direction. Followers mean fucking zero on Clubhouse. There's people with 3 followers that are brilliant. There's people with 3,000 that don't know their ass from a hole in the ground. Okay. So hello to Alexander, Antonio, Michaela, JD, Claire, David, Cutter, Catherine, Christian, Franklin, Mono, Hog, Francois, Manny, Lance, Monica, Lil Gaines in the house, Victoria, Akram, Mehmet, is that right? Mehmet? Juan, Mukhtar? Man, I don't know. I'm going to give it a go. All right. So hello, Tom, Vincent, Rouleau, what's going on? Yeah, sorry about Theta. I'm not sure if they did some switching up of their stream keys or what's going on, but sorry, dudes. I'll post the video to Theta later, and I'll make it available. I'll make it available to everyone, not non-subscribers. How about that? So you'll still get to see it. Okay. Let's go to the opening graphics. Then we're going to bounce back. We're going to go through prices. Yes, you see up on the screen, top shots. There's a pack going out today. Alexander and I are going to try to snatch this Mofesia. Now, the thing is, it's a lottery, and we don't know exactly how many packs are going out, but we assume it's a very small amount, somewhere in the 53,000 range or less per morning listing. There's 3 listings. There's one today at 9 a.m. Pacific. There's one today at 5 p.m. There's another one tomorrow, I believe, at 9 a.m. I think that's how it works, Alex. But we'll know soon enough. So hopefully we'll win the lottery and we'll get, or no, the tomorrow one is 10. Okay, got it. Oh, they let us sleep in. Fancy. Okay, so let's get the show started. We'll be right back, and then we'll have some fun. those of you that hear this little fan sound, it's because there's a little fan sound. I don't know what makes the fan come on. I don't know what makes the fan go off. I'm not sure when it's frustrated, when it's not frustrated. I don't know. Let me say, for those of you on Theta, not streaming to Theta, go to YouTube or Twitch. Sorry that our life sucks so badly. 8th grade typing skills coming back. JR, what's going on? Ashley, what up? Biotech breakout. Okay, cool. So, hello, Angela. Hello, Expat. Hello, Stefan. Mark. Cool. Cool, man. Cool, man. Let's talk prices. And we have to get this in 9 minutes. We have to talk prices in 9 minutes. Okay? Because NBA Top Shots. Because, you know, where my priorities lie. Certainly not helping you guys. Okay, right now, the Bitcoin is selling off a little bit. And this has been intensified over the last about hour. It's down about 5 points. The general market is down. Inflation expectations. Now, this is not to be confused with inflation. We're going to talk a lot about inflation later. We're going to talk about the whole treasury market so that you guys understand when everybody's throwing all this stuff around, yield curve inversion, flattening the yield curve, zero lower bound, blah, 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 trying to sound like dickbags. I'm going to explain this all to you so that you go, okay. They're just talking about different pieces of government debt and what that curve of the different prices and maturities of that debt looks like. So, yes, Crypto CB, we know that for whatever reason, StreamYard is not broadcasting into Theta. I got a little sign that said, sorry, dude. Sorry, dude. So they may have changed stream keys. They may have done something weird. We'll find out, but we're not going to find out right now. Okay. So the Bitcoin right now is down about 4.8%. It's at 47,453 buckarooskies. Why is that good or bad? It's not good or bad. I was looking for any kind of definitive information. What I will say is that GBTC is trading at about a 12 or 13% not premium discount to the crypto price. If you want a quick arbitrage, you may look at buying GBTC right now. Alexander, that might be something for some of your clients. You can buy GBTC right now, wait for it to settle, and essentially you're getting Bitcoin at a discount, at a 13% discount. That right there is legit. That is a real discount, okay? And so it's something that we should all kind of think about. All right, especially for people that don't want to get into the crypto space directly, and they have a 401k or they have some kind of other exposure to the traditional markets. And even in an IRA, you can own, now they have Bitcoin IRAs, but even in a regular IRA or any of these other, some of the 401ks too have the dexterity that you can buy GBTC. So that's kind of cool. Anyway, Bitcoin at 47,478 bucks, down about 5% on the day, about 1% on the week. So it's traded flat. Good for the options traders. Bad for the people that want to go live in their Citadel cloud cities, at least this week. So it's cool, man. And we'll get to it. And yeah, Tom, BTC, a little short-term pain, but nothing we can't brush off. And again, if you're trading the options market, you love this. You freaking love this because it's putting the premiums back on the put side. And that's what me likes. Okay, Ethereum, 1469. It's dipped. It's actually got kicked right in the nuts. It's dipped down below 1,500 again. It's down 7.5% on the day, 5 on the week, 7.5 on the 30-day. Ethereum's not faring well. Where are all these people that were saying Ethereum to 20,000? Was it Raoul Pal? Raoul? 20,000 because of Metcalfe's law? Do you even understand anything, dude? I like Raoul. That's not true. All right. I just told a lie and then lied about the lie. Oh, what's wrong with me? Okay. Well, what's the good thing about Ethereum being slightly less than it used to be? Well, maybe the fees come down a little bit. I mean, if the price dipped 30%, then I guess the fees have dipped 30%. Have they not? I think Alex was telling me last night that he actually did a transaction and the fees were low. on Ethereum. Dear boy, Ethereum. So that's awesome. Okay. So if you're moving money back and forth and you're doing swaps, good for you. Maybe do some rearranging in your portfolio now before those fees get caked back in there. Okay, Cardano, $1.14. It got down to $1.04, and I was starting to salivate a little bit. I had skimmed at skimmed. I skimmed at $1.36. Somewhere between 135 and 137, but let's just say it was $1.36, and it was last Saturday. And I put 57% of that skim into Bitcoin when Bitcoin was around 44. So I'm still up on the Bitcoin about 7%, meaning so my math was when I got to where I was a full 40% sell off, I was going to buy back in. It didn't get there. It bumped back up pretty vigorously. So we will see. We're still waiting for announcements for Cardano. Everybody's waiting for partnership announcements, meaningful partnership announcements. They're asking for clarity on Alonzo, which is the last part of the Gogan rollout. There is going to be, this is from Charles Mouth from an AMA he did yesterday. There's going to be an NFT marketplace. Yes, Cardano runs on Cardano. They are creating an NFT marketplace. One should think when they do something, they typically do it well. They haven't done much, but what they do comes with a lot of science. So my guess is whatever fee structures and frustrations currently exist in launching NFTs. Alex and I launched an NFT yesterday, as a matter of fact. We went through the process, and it cost us about $50. We launched, matter of fact, I think I can show you. Do you guys want to see our NFT, our Crypto and Coffee exclusive NFT? Bam! That's right. Let me see if there's another, if you can. Ooh, you ready? That's right. Because we are fancy. So that is, and so what we're doing is it's one of three. There are 3 images, and then we're destroying the original artwork. That's right. If you want to own a part of history, you can go to OpenSea, and I think you can look it up. It's actually, I put a link in the description. But anyway, except for me, I don't give a F. See, I did that without cussing. You're welcome. All right. Okay, we are about 2 minutes away. I'm going to go and talk about one more thing. So good. So NFTs are coming to Cardano. That's very interesting to me. We'll see where that plays out. Yeah, it is like a Banksy, right? Except that, mine's not good and Banksy stuff is good, and mine is marginally relevant, and everything he does is relevant. And I'm going to convince Alex to sell me one of his Banksies. Okay, cool. All right. Polkadot. Polkadot's been selling off like a mofo. Why? One, they're not providing clarity. Gavin, you and the boys are not providing clarity on when this parachain offering is going to happen, and also freaking how it's going to happen and what it's going to look like. No one understands what the F you guys are doing. Please provide some community outreach. Please provide some clarity so that we know what the F is going on. Anyway, it sold off quite dramatically. It was up around 40. It's down to $32. Still doing pretty good. Let's face it. We were following this thing at $3 in June. This is not $3. This is almost 11 times that. So it's still up about 1,100% in 8 months. That's not terrible, but this could be $100 or $200 token if they would provide some clarity. I'm guessing that in their race to beat Cardano out the door, they might have over assumed that some of their software milestones. We'll see. All I know is this was supposed to happen in January, and it didn't happen in February. And so here we are in March. Yeah. How are you unsub? BZ, no, you weren't unsub, dude. What happened is We had to switch channels because YouTube shut us off. They actually closed our channel. Okay, let's talk about XRP and XLM. These are bridge assets. They're both kind of selling off together. It looks like the world kind of considers them the same thing. One of them's in legal trouble. One of them isn't. But if I was going to bank on one of these guys making it, I would bank on Ripple making it. And I'll tell you why. Because if I look at the DNA, if you forget Bread Garlic Mouth and Chris Grand Larceny, if you get rid of those guys and you just look at everybody else, I would put my money on the team at Ripple. Oh, crap. Hold on. 10 seconds. Give me just a second, everyone. Okay, that's the old drop. Here's this drop. Okay, let's see. We're loading. We're loading. Join the drop. I am not a robot. This is a vehicle. Oh, come on. I am not a robot. This is a crosswalk. I'm glad you guys are, I'm verifying that I'm not a robot. Let's see if we're in. Ooh, this is exciting. Okay. In 13 minutes and 32 seconds, we are going to see if we get a pack. Oh, man. Alex, I know you're stressed out as much as I am. Okay. So here we are. So we're back. So if I was comparing these two teams, I still think the DNA at Ripple and their partnerships and agreements, to me, seem more material. You also have Ripple Asia. I know that the Stellar Foundation is building in Africa. I just don't know in what way and if it's meaningful. So as much as I dislike a few of the people at Ripple, the company in general is something that I would probably get behind. It's a real company, right? Yes, they're in bed with the bankers, but so what? Bankers aren't going anywhere. And as we're going to learn later in the show, you need to understand the legacy system to understand why there's such an opportunity in the crypto space. And also so that all this information that's floating by on the traditional media, it's not lost to you. If you understand the treasury market and yields and repo and things like that, and the risk, the kind of the yield and risk and how it translates inversely to the cost of debt, you can take those kind of basic fundamentals and you can apply those to corporate debt. You can apply those to senior notes. You can apply those to what's happening in the legacy financial system and see why it makes so much sense for certain areas to utilize the reduction in frictions that distributed ledgers and things of that nature have to offer. So it makes more sense. Cool. Okay. So let's get past the bridge assets for now, which, by the way, I think there's no need for. So if I was to pick XRP over XLM or Ripple over Stellar, yeah, that's one thing. But if I back out further, I'm not sure that whole business exists. And then it becomes, okay, what do you have past swaps? Well, you can develop on Stellar. You can't really develop on the ledger, on the Ripple ledger, the XRP ledger, XRPL. So I don't know. Yeah, some people be like, yeah, you can. You get into their little coil thing and all this other whatever, their VC fund, all this kind of book, X Spring. No, dude, you can't. It's for 6 people and everybody else is stuck out. Okay. Hush, man. Hold on. I don't know why it wants to. Yeah, whatever. Okay, I had my phone set to remind me 45 times if for the pack. Okay. Cosmos has sold off a little bit. It actually was having a pretty good day yesterday. It was one of the winners, and then it kind of sold off pretty dramatically, 8.5% down. But it's still up at $18. It's still up 374% on the year, which isn't, knocking home runs out of the park, but it's a layer 1, and we like layer 1 exposure. Theta is doing pretty great. It's up almost a 30x on the year, 29x on the year. It's up 92% on the 30-day, 33% last week. It had a great week. Beginning of this week was great. It's down a little bit today, but everything's down a little bit. Let's check back with Bitcoin, 47. Okay, so Bitcoin's starting to come back up. Okay, so back to Cosmos. We will see. I'm not sure that they are meaningfully making their argument to the rest of the world why they should be utilized by, why should you use, Cosmos? Why should you use their token, their platform, blah, blah, blah. You have to make that argument. A lot of this, well, listen, all of these markets are psychology. And if you're not getting out there and communicating your message, we don't know what you're thinking. And if we don't know what you're thinking, we kind of don't care. All right. Theta. Unfortunately, for whatever reason, we're not broadcasting to Theta today. We're trying, but it booted us, meaning they may have changed the stream keys and I have to resubmit the stream keys. I don't know. We'll figure it out. But yeah, not on Theta today not because we chose to. That's probably why Theta's down. Theta's probably down 3% because this show and the 40 people that watch it are very perturbed. So they're like, you know what? I'm shorting Theta. I'm out. I'm selling my Theta because I can't watch Nick curse profusely. Okay, VeChain. So we have our China play. VeChain, and it goes not in this order. It goes VeChain, Neo, IOST. Those are the three. That's our emerging market exposure. VeChain was doing pretty good. It's actually up about 20% on the week, 700% on the year. It's down today. Everything's down today, but it was doing pretty good. It got up over 5 cents again. We're starting to have a run. They think it's about to be in breakout mode. VeChain 2.0 is going to drop, and all sorts of, magical dragons are going to fall from the sky. We're going to be showered in wealth and riches. But until then, it's 5 cents. But it's technically under 5 cents. It's 4.989. Yeah, it's like a breath below. And if it's below 5 cents, I am a buyer. So today I will add $3 to my VeChain pile. Every day, $3 if it's under a nickel. There we go. Neo, $37. Still having a pretty good run. It's up a couple 100% on the year, but it's down on the day, down on the week. It's Ethereum light, right? It's Ethereum, but there's Neo and then there's Neo gas. You're starting to see these protocol layers that have a second token. Sometimes the second token makes sense to carry that gas function. VeChain has VTHO. Neo has Neo gas. Theta has T-Fuel. You're starting to see a little bit of pattern here. So depending on how these protocol layers are built, sometimes it makes sense to have a gas token to absorb some of the elasticity and contraction in the fee structure. Makes sense. I'm not a big fan of tokens, right? I feel like if you can't sort it out at the protocol, why are we having to juggle these goddamn tokens around? But it is what it is. All right, let's go to Graph token. Bum, bum, bum. It's $1.79. It's down 7 on the week. Down 1 on the week, 1.5. It's down 7 on the 24 hour. So yeah, it's taking a kick in the softies. It's still up. It's still way up on the year, way up on the 30-day. It's up 130%. Graph token's doing great. I see a lot of amazing things for Graph token. So we will see. I guess, it's not a layer one solution, but it's right there. It's definitely not a specific DApp either. It's a tool for developers. So it sits right above that first layer. It sits, you know what it is? When you build a highway and then you spray that stuff on the highway to keep it clean or whatever, it's that stuff that you spray. So it's not the highway. It's not quite the infrastructure, but it's definitely tools that sit right at that infrastructure layer. So we shall see. It was up over $2 yesterday. It was having a pretty great little run there. And it got about 3 weeks ago, it got as high as $2.90, I think $2.92, something maybe a little bit higher, depending on which exchange and for how long. Okay, Engine token. It's $1.22. It got up to almost $1.50 yesterday. But you know what? It's up 100% this week. 240% on the 30-day, almost 1,000% on the year. It's down 10%. It gave some back. But again, it's up 100% this week. It's having a pretty good week. It's almost protocol layer exposure. It's not a protocol, but it's almost protocol layer exposure to the NFT space. There's a lot of NFT hype. You can either go after NFTs like this amazing gem That's right. The I don't give a F crypto and coffee original. You can either spend 2,000 Ethereum. That seems like a fair price. No, I'm kidding. Or you can buy these fundamental layers like Flow, like Engine, and you can get in kind of underneath the surface. Why do we like Engine? Well, partnership, you know what, I'm not going to go into their partnerships, but let me just say that they've been working with, I believe, Atari and Microsoft about doing some cool things. I know that they are, I believe Engine has to do with, you know what, I don't want, let's do a whole thing on Engine next week. On Engine, probably we'll look at Engine and Flow a little bit deeper. We talked about the financial side of it. We may dig into what some of these partnerships might mean, like the video game partnerships and Minecraft and stuff like that. Let's say that for another day. But anyway, suffice it to say, if you want to get exposure to the NFT space, a couple of ways you might do that is with Engine and with Flow. So let's talk about Flow. Flow right now, kind of difficult to get. Yes, I understand, but you can get it over at gate.io. And for those of you that can't, I'm sure you know someone that can, yada, yada. You can also stake this directly with Flow, their Flow network. And so that's kind of cool. Great. I'm using, I think the stake pool I'm using is Bison Trails. Anyway, I staked on their consensus staking, whatever. All of their, it doesn't matter. Point is, you can stake this. The rewards range from 4%, which is fair, to 20%, which is egregious. I don't know what determines where and what and how and all that. I'm guessing the rewards early on are good. Now, for anybody that wants to stake, as long as you get in before the 9th, if you get your assets set up and staked before the 9th, Tuesday at 10 p.m. Pacific time, I believe, that's when the next epic starts. So you have until March 9th at 10. Great. Good for you. Okay, IOST. This is protocol layer exposure to emerging markets, China. Is this some kind of magical token? Well, we don't know, do we? It got up as high as about 7 cents for a few days about 2 weeks ago. It has since sold off a little, but it's still doing pretty good. It's flat on the day, up to about 10% on the week, 180% on the 30 days, 750% on the 1 year. So that's not bad. I have 1 inch in here because I've decided I want to watch 1 inch. It's the safest of the DeFi plays. And it's gotten kicked in the nuts pretty solid. It's down 9% on the day, down 28% on the week, down 29% on the 30 days. So basically, over the last month, it's dropped about a third. Where did I get in? I got in. I'm actually underwater on this one, except that the staking is so freaking ridiculous. How much? It's like 33, 34% a year, which once we go a little deeper into the yield curve, which we're going to do here in a minute, you'll understand why that's crazy. And then that the only way these things can be done is by showering you with made up governance tokens that only really have value to other people participating. So we hope for good things from 1 inch. They're the best in breed, but by no means am I telling you to invest in this. Matter of fact, I'm telling you not to. But in my opinion, it's the best in breed, but also don't do it. Okay. What was my position is a 1% position of my portfolio. Okay. So to give you an idea, that's how much I trust DeFi. And as we saw yesterday, people can just, take your stuff and go, here, thank you for your money. I'm gone. Haven't heard a lot of CZ Binance talking about that, have we? Oh, he was all big. He was all big stuff. Woo, Binance chain. Woo, smart chain. Woo, uh-oh, I'm out. Oh, I can't talk. I got to attend to my boat. I got to tend to my boat in the international waters. Okay. Near protocol, $4.18. It is down on the day, down on the week, but it's up 66% on the month. And it's actually up quite well on the year. It hasn't been out a year. It's still not on Coinbase. It is a Coinbase venture. A16Z, Andreessen Horowitz, as well as some hush. I have nothing to say to you, salespeople. So this is if you're going really deep into the protocol layer and you're saying, I want to have exposure to every protocol layer asset, then I think you look at Near. I think for many reasons, it makes a lot of sense. For many game theoretical reasons, it makes a lot of sense to have exposure to Near. There's also Maker, Graph Token, I think 1inch. I think they are all porting over to Near. Near has already achieved what Ethereum would love to achieve. If you believe in Ethereum 2.0, you better get your butt on over to Near and do some reading, because my guess is you're going to look and go, oh, they've already done everything. They've already done literally everything that Vitalik and the rest of the homies endeavor to achieve. Ugh. So we'll see. Okay. We'll take one last look at the Bitcoin. So 47.7, it's coming up a little bit. So it's not completely S-ing the proverbial bed, but there we go. Okay, let me say hello. Let me go back and say hello to a few people that have showed up. Let me say hello to Sunil, Crypto CB, Ella Paul, Gary, Al Greco, Scott, Joe. What's up? Good to see you over here. Coins Daddy, what up? Polkadot now on Ledger, and you can stake it with Ledger Live. Ooh, that's good news. So for everyone that's got Polkadot, you can put it on your Ledger, go into the Ledger Live app, and you can manage it from there, and you can stake. So that's super dope. Let me say hello to Vincent, to Hoop and Tony, BZ. Hello. You weren't unsub. To Nick, Jared, to, did I say hello to Bobby? If not, hello. To that Pipeline, Brady, Tiffany's, and Timothy. Good to see everyone. Yeah, sorry that it's such a kick in the whatevers for Theta. We'll figure it out. Barna, what up? Okay. We're going to take a look at some other things. First things first, before we go, well, let me just go over here. I'm going to show you, I'm going to blow your minds real quick. But before I blow your minds real quick, ooh, dude, Alex, what number did you get?
I'm a cool 83,000.
Did you see my number? It's right here. Do you guys see this? 2,139.
Pack secured.
I'm going to get a pack. This is fantastic. Whew, I did it, y'all. I did it. I'm going to get to spend $14. You're going to see it here. What, Joe? 187,000. Joe, are you kidding? You're kidding, right? Oh, man. It doesn't matter. Let me tell you something funny, Joe. For those of you that were waiting for packs, we've been doing this. How long have we been doing this, Alex? We've been doing this for, I don't know, 3-4 weeks now. We're not OGs, right? We haven't been in here forever. One of our buddies is an OG, but we're not. And Jesus Christ, there's over 190,000 people in line. That is stupid. We were trying to get packs for so long, and every single time, doesn't matter when we would enter, we would always be, ridiculous. Okay, it just posted a note that said 61,086 packs are being available during this drop. So that's kind of cool. But every time we did it, we would, almost at the same time, we would both enter, and our numbers would be completely random. So they are assigning completely random numbers to people. It really is a lottery, I'm guessing, because that's the only way. So what's your number, Alexander?
I am 83,692.
Yeah, you're out. You're out.
I'm out.
Yeah, because there's no way 20,000 people are going to botch that.
No way.
So I'm guessing they're going to lock everyone out for tomorrow. So hopefully the people that get today, those 63 people, 61,086 people are locked out. Obviously, they're not going to let them compete for tomorrow, right? We hope. I don't know. Well, anyway, very exciting news. So we're gonna chat about this, but I want to talk a little bit. I want to switch gears while we wait for this pack to unearth, and I pay for it. I'm going to show you the whole process. I want to talk a little bit about government debt, because I think it's something that a lot of people assume they understand, and you may understand it. You may kind of intuitively get it, but if you haven't kind of been shown it, then it won't necessarily make a lot of sense. And I want this stuff to make sense to everyone, because if you understand the legacy financial system, you'll understand better why it makes sense to come over into the digital asset space to solve certain frictions and to reduce stress. And it's not that every single product in government debt, the whole repo market, all of this stuff, at least in the near term, is not going to be recreated digitally. But digital assets, certain digital currencies, digital equities, whatever nomenclature you want to give it, they are going to be used to reduce frictions in those markets. But if you back out from there, you say, well, how does understanding these markets really make a difference to me? How it makes a difference to you is, if you want to understand how the digital asset space is going to form and where value lies and where you think people might be overpricing or over or undervaluing an asset, you need to understand the legacy system, because then this all makes so much more sense. But if you don't understand the system, if you don't understand how government debt is sold, created, auctioned, and all that, and what the different products are, none of this crap's going to make any sense. So let's start with a few things. And I've even done some drawings for you guys because I care so much. It's everybody says I care. They're like, that Nick guy, he cares. Okay, so let's go over to our fancy banners here. And let's start with, you hear it all the time. There are Treasury bills, Treasury notes, Treasury bonds, tips, floating rate notes. What the S? These all make up the majority of government debt. Government debt is considered to be the most pristine of all collateral, and U.S. government debt, the pristine among the pristine. It's AAA, meaning the government would never default. They can just print up new money, and as long as they can print up new currency units, they could always pay back their debt. And that's not a lie, while it is disingenuous. It's not technically a lie. They can print currency units and pay their debts. The problem is that if they print those currency units and those currency units escape out into society and chase consumer products that we like houses and eggs and milk and cars and clothing, then there's more currency units showered onto society for the same amount of products, meaning that on the aggregate, the prices go up on those products to meet those currency units' demand. Does that make sense? Also, as more currency units are showered onto society and your savings are fixed, if you increase the supply of currency in the actual, broad money, your savings are being devalued. Now, it's not proportionate one for one. Eventually it is, but there's a lot of investor psychology and panic psychology kind of cooked into that. But you need to understand what the actual bits and pieces of the debt market are, so you understand what are they trading? What are they talking about? What are they talking about when they're saying 210 spreads and T-bills versus notes? You think this is all the same stuff. It's not all the same stuff. These are all different kinds of debt. And a lot of times it has to do with the duration, right? Duration, the time. So, and I've got a very cool graph, and I will show you this very cool graph. But as you can tell, we're only 807 away from purchasing this pack. So let's first go through the definitions so that this stuff makes sense. You hear it all the time. Treasury bills. Boom. Treasury bills are short-term government securities with maturities ranging from a few days, yes, like literally days, to 52 weeks. So when you hear bills or T-bills, okay, it's a year or shorter maturity, okay? T-bills, all right? These are the most liquid. They get rolled over all the time, and sometimes people hide in these assets. Why? Because if you have cash and it's just sitting in an account and you're making nothing on it, sometimes, especially for, funds and money markets, it makes more sense to at least get paid something rather than nothing. Now, the problem is when you start applying inflation to that, you start realizing that almost everything is negative, like pretty deeply negative. If CPI, consumer price inflation, and again, I understand that CPI is a government number, but you can compare CPI to other CPIs because it's at least consistent in its underreporting. So if you just believe that it's consistent, and maybe it's inflation's 10% or 15% or whatever Michael Saylor says, okay, cool, but we need some number that we can, we can't just always go off of, shadow statistics. At some point, you need to have some number, and CPI is consistent. So if you apply CPI, which is less than 2%, well, let's call it 2%, to something that pays you 10 basis points or a tenth of 1%, well, you know that you're actually, the real rate is negative 1.9. Does that make sense? You subtract what you're actually getting from what inflation, you have to subtract inflation, and that's what you're left with. Anyway, when you hear Treasury bills, and this is what they talk about all the time, they're always talking about bills. Ooh, only 153 users in front. This is very exciting. Treasury bills. Okay. These are short-term government securities with maturities ranging from a few days to 52 weeks. Bills, T-bills. Oh, let me take that off the screen. Bills are sold at a discount from face value. Okay? Uh-oh. Some stuff just happened. It made a noise. You guys heard that noise. Did you not? Ooh, let's wait and see what happens. Jesus. Over 200,000 people in line. You think that when people saw the thing that said that there was already some 100,000, you think that would be it. You think that people would be like, I'll just do it tomorrow. But no. Let's see. It is your turn. You're almost there. You will be redirected to the website as soon as possible. I'm not sure what's going on right now. Do they sometimes send us an email? It's very interesting. So for those of you that are just listening, we have a pack coming. We just don't know. At some point, something's going to happen, but it made a cool sound. Made a badass sound. Oh. Bye now. Trying to snag a reservation. Ooh, there's 58,714 left. Heading to checkout. Oh, Jesus. Hold on. Let me do this in a way. Let me do something real quick. I've got to probably try to do this in a way that's not going to. Give me 10 seconds for station identification. I've got to do this in a way that's not going to expose my details to the whole world. Okay, no worries. We'll get this done. Yes. Use my balance. Make a $14 purchase. This is all very exciting. You guys are not near as excited as I am because I get 3 moments. But Alex and I have a deal where since we're working together as a team, Alex, should we keep this pack closed or should I open it? Because technically I could open it on screen.
We have to see how it plays out. Are you able to get are you able to participate in the next 2? Am I going to get one? Because then we'll leverage that. So wait on.
Okay, we're going to wait. So yeah. If Alex can get one, then we're going to sell one pack unopened and another pack. Whatever. Okay, cool. Anyway, this is kind of fun. So I'll leave that there. I'm going to go to my sketch now. So we do have a pack, y'all. We did it. High five, everyone. We freaking did it. We freaking done it. Bam! You guys ready to get blown away with some artwork? Okay. So we know about Treasury bills. Let's talk about Treasury notes. Treasury notes are government securities that are issued with maturities of 2, 3, 5, 7, and 10 years. These are notes. Okay? When you hear 210, they're talking about the beginning and the end of those notes. 2 is the lowest end. It's a 2-year, 3, 5, 7, and 10-year. They pay interest every 6 months. So these are notes. So remember, bills, a year or less. So just think the Bills, like the football team. They've only had one good year in history, right? So that's the Bills, a year or less. Notes are 2 years to 10 years, okay? They pay interest every 6 months. All right, let's talk about bonds. You're like, damn it, isn't this all bonds? Well, technically they're all bonds, but they're not Treasury bonds. This is all government debt. Treasury bonds pay interest every 6 months, just like notes, and they mature in 20 years or 30 years. Wow. So think of bonds as like the long end of the notes. The notes are 2, 3, 5, 7, and 10. They pay every 6 months. The bonds are the 20-year and the 30-year. And this is the high end. When you're looking, this is kind of like this high end here. This is a, by the way, this green, this is a normal yield curve. Normal yield curve. And actually, let me see if I can make that a little bit easier. If I could take my fat face off of there. Okay, cool. Now, so we're looking at the, you'll notice on the screen, and by the way, I didn't borrow this. I freaking made this because I heart you guys. Interest rates set across is the on the left, and that's going up from 0 up to, we'll say, 8%. And I'm going to talk about that 3.5% death spiral zone. And then we have the dates or the time durations. These are also what would be considered maturities, right? So you'll notice 1 month, 2 month, 3 month, 6 month, 1 year. Those would be Treasury bills. Then you have the 2, 3, 5, 7, and 10. Those would be notes. Then you have the 20-year and 30-year. Those would be the bonds that we're talking about. You say, well, what if I'm worried about inflation? Ha, 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 my friends. Do not worry. You can buy tips. Inflation protected securities. What? Tell me more. Okay. These are marketable securities whose principal is adjusted by changes in the CPI. So you notice when I say CPI, it is important. Even if you don't believe it, it is consistent. And you need to understand the CPI because that's how they adjust tips. Tips pay interest also every 6 months and are issued with maturities of 5, 10, and 30 years. Okay, so they would be in between notes and bonds, right? So that's where tips fall in. You can't buy 2-day, 6-day, 1 month. You can't buy, Treasury bills, which are those short terms. Remember the bills, they suck, 1 year or less. You can't buy inflation protected bills, but you can essentially buy notes and bonds. So these are marketable securities, principals adjusted by changes in CPI, which they now refer to as CPII. Tips pay interest every 6 months and are issued with maturities of 5, 10, and 30 years. Okay, cool. I'm going to make sure. Let's see. Hoop and Tony, good to see you. Antonio's over here too. Cool. What's up, man? Demayan and Tiffany and Fern. Ooh, interesting. Anybody else? Did anybody else get a pack? If you did, let us know. I'm curious. How do I purchase? Oh, you're so kind. If you are curious, in the description of the video, I have a link. It's on OpenSea. I'm going to show it again. Now, this isn't completely me. This is something that myself and Alex and Leroy were talking about yesterday. And I did this because we wanted to go through the experience. There are only 3 of these. It is the original artwork for the this is the original artwork for the shirts. We had a limited edition of Crypto and Coffee TV shirts made when we first got booted off of YouTube. So this is we got banned from YouTube. And on the front of the shirt, it says, everyone wants to be liked and accepted. And then on the back, it says, except for me, I don't give a F. Okay. Anyway, yeah. So if you want to check that out, that is on OpenSea or Rarible. And there is no minimum price. You could put like $1, right? There's no minimum price. It's just a little auction. And we'll probably use whatever we generate to simply do more cool NFTs and just kind of go through the whole experience. Everyone else we should be too. But there's only 3 of these, so that's kind of cool. Yeah, okay. Off we go. We're back to debt. Let's go to debt. Now, Steve, what's going on? Good to see you, man. Let's see. Are there options on tips? Well, there are kind of ways of getting exposure to all of these assets. I don't play derivatives of debt, but I'm sure you can find ways to kind of skim that. I'm sure there's some product against that. Okay, there's one more thing we need to talk about. FRNs, ferns, fern like prism, ferns. What a segue, right? You guys are like, what's he doing with this segue? All right, floating rate notes. These are interest payments. Interest payments on a FRN, a floating rate note, rise and fall based on discount rates for the 13-week Treasury bills. Okay, and remember, what are bills? Those are short-term, 52 weeks or less. Ferns are issued for a term of 2 years and pay interest quarterly. Okay, so they look at the discount rate for the 13-week bills, and they pay quarterly interest that's adjusted off of that. Okay, do people mess with floating rate notes? Some people do. It depends on what your kind of balance sheet management strategy looks like. Okay, let me take that off the screen. Let's talk about this curve for a minute here. Here we go. We have interest rates from low to high, okay? These are yield curves. This is a healthy yield curve in green, okay? Healthy yield curve, yay. This is the Fed's current kind of yield curve. Now, it's been adjusted recently, but this is yield curve control, right? Or a pegged curve. What do they do? Well, what they basically do is they come in and say, these are the prices. That's why it's in red. This is the no, you can't trade off of this zone. These are the prices. Why do they do this? It's a variety of reasons. One, it's to manage their debt. It's to manage the fact that they can roll over their debt, because if interest rates go up, they can't roll low interest rate debt into high interest rate debt. They can't service their debt. It's like if you have credit cards, you don't roll over credit card debt from a card where you're paying 8% into one that you're paying 40% or 30%. That doesn't make any sense. You can't afford that, especially if you can barely afford debt service, or even if you can't afford debt service. Well, then what happens is there's a wall. So you'll notice that there is the flattened kind of red. That is that's a pegged yield curve. It's slightly up. You're getting paid a little bit more for longer duration debt, right? 10, 20, 30 years. That's the way it should be, because risk equals yield. With more risk, and time is risk, right? Giving the government your money for more time, there's more inflation risk. Therefore, it makes sense that you get paid more for taking that risk. Okay? So anyway, green, healthy yield curve. Makes sense, right? Let me go over here so I can see your comments just in case. Okay. So the green is a healthy yield curve. Now, healthy yield curve, right? You're getting paid more for taking more risk by giving them your money for a longer period of time. Okay? All right. Now, managed yield curve, pegged yield curve, whatever you want to call it. This is when the Fed says these are the prices. Okay? Now, to an extent, the Fed can't really do that. They can kind of do that. They can't force it, because if you were to look really closely, this is what's happening. Whatever they say the yield curve is, it's still people doing deals over and under and over and under the price. Because if the Fed says this is the rate, that's fine for the Fed, but everybody else, they're going to do deals that make sense for their own balance sheet. You're not going to tell Chase what they can or can't sell debt for or loan it for. So if they've already bought these pieces of very pristine collateral, they can retrade those, and in some cases rehypothecate, meaning take sketchy collateral, borrow against that sketchy collateral, buy treasuries, go into repo, borrow against those treasuries. See, there's all sorts of clever and nefarious things that can happen. Anyway, this is a managed or pegged yield curve. When they talk about the Fed pegging the yield curve, that's what we're talking about, forcing these rates. This is at or near, we'll call this 0 right here, right? 1, 2, 3.5. Okay. Now you're going to see this purple one. This is an inverted yield curve where at the close maturity or near term or right now, you would be at, say, 1.5%, 2%. Again, we're not anywhere near that. We're close to 0, but this is just a thought, so that you can understand visually where the rates, if the Fed was to raise the near-term rates, like they tried to do an Operation Twist and it was a complete failure, but if they were trying to raise the near-term rates, you would get in the near term, because this is very liquid, the idea is it would push people to take risk further out, that thereby ideally lifting the rest of the curve. But what happens is in the near term, they bring up the short end of the yield curve, and it can create an inversion where no one wants to. Basically, people are hiding. This would mean people are hiding in the government debt market, right? And that's an inverted yield curve where you get paid more for near-term debt than for long-term debt. Now, does that work? Well, that would only make sense if there were zero expectations for inflation. And remember, or at least keep in mind, that these curves, these are determined by psychology. This is still investor psychology. The bond market doesn't tell you what's happening. The bond market tells you what traders and debt holders and debt borrowers expect to happen. These are all forward-looking expectation markets. If you have the expectation of debt, then typically you see a healthier yield curve. You see spikes. Now, there is an interesting thing. So we know this is a normal yield curve. This is healthy, right? With time duration is greater risk of inflation. Therefore, you would expect to get paid more for giving the government your currency units, expecting they're going to print more currency units. That's going to devalue, and you need to be paid for that risk. Okay. This is a pegged yield curve in red. This is an inverted yield curve. All right. And you would imagine that here, if it's more money piling up in the short end, which usually happens. Why? Because people want to roll over debt, and they usually these are balance sheet transactions that are occurring typically in the repo market. Now, how would the Fed do this? You say, well, they could say whatever they want. How does that actually affect it? How do they actually create this? Well, what they do is it's IOER, interest on excess reserves. What the Fed does is they say, okay, we're going to raise the overnight lending rate that we will pay to banks for parking their excess reserves with us. And so it's game theory, right? If we raise our overnight rate, why would anyone be incentivized to go sell that same debt or those currency units? Why would they go trade in repo or in the money markets when they can come directly to the Fed and get a higher rate? Makes sense, right? You would just go to the Fed. So this starts to get this, it starts to make more sense. Okay. All right. So how does the Fed manage the yield curve without actually pegging the yield curve? Let's talk about that real quick. So the Fed buys at the long end of the yield curve, which is over here. They would buy. So what they do is they print up a bunch of what George Gammon would call funny money, what Jeffrey Snyder would call coupons, bank reserves. Now, Fed bank reserves are not the same as a bank having cash reserves. These are two different things. Federal Reserve bank reserves are coupons. They are not money. They're not traded in the broad economy. You can't buy burgers with bank reserves, okay? They are literally coupons, but they're coupons that trade within the Fed banking system. They trade among the Treasury. The Treasury creates debt notes. Okay, they're basically selling future prosperity. They create these notes. They sell them. Let me do something real quick so that this is not so completely impersonal. Bam. Okay, so they create these notes. They sell these notes, and they sell them to banks. What the Fed will do is they will trade the banks. They'll say, hey, listen, as part of this kind of warehousing process, you guys buy debt from the Treasury when they print it up. We will trade you bank reserves, these coupons, which will allow you to balance out your books and continue until you flipped that debt into the more public markets like repo and money market. So, and again, I know some of this is confusing, but just get the broad picture. So what the Fed will do is to manage, because there's this 3.5% death spiral zone. And I'm going to talk about that in a second, but it's very important that government debt, and to a greater extent, that corporate debt, and so they're one and the same once you get into the repo market. Essentially, debt that gets above about 3.5% is untenable. We're just at that point in society where we borrowed so much and we're rolling over so much debt. And I say we, I don't mean you and I, although you and I are probably doing the same thing, where the government is rolling over so much debt and corporations are essentially selling their debt and buying their stock and selling their debt and buying their stock, which you might say is a Ponzi scheme. Of course it's a Ponzi scheme. This whole thing is a Ponzi scheme. But above 3.5%, no one can roll over their debt because they borrowed it near zero. And they can't basically get out of the debt as the debt rolls off the balance sheet or it expires, and they can't take on new debt. So if I borrowed 10K on a credit card paying zero, and I can barely pay that, I can't roll that onto a credit card that charges me 3.5%. I certainly can't do it if it charges 8 or 9%. If you guys remember the repo rumble 1 September ago, 2019, technically about to be 2 Septembers ago, overnight, the lending rate went from, between 0 and 2%. And because there was no quality collateral and lenders stopped lending, the overnight rate went up close to 10%. That is Armageddon, dudes. That is financial apocalypse. So the Fed had to come in, and they had to act quick. I mean, like that night. They came into repo and they bought all of this shit, all of it. And the idea is if you buy it, the more buying that happens, the Fed buys at the long end of the yield curve to lower yields so that the corporations and the government itself, consider the government a corporation, can continue to roll over their debt at manageable rates. Why? Because when you buy more debt, if there's more buyers of this debt, then the prices of the debt goes up, right? There's more competing buyers, but the price of debt and the yield are inverse. So the actual yields become reduced, right? There's more buyers. Why do yields go up? Yields go up to entice buyers into the debt market, right? So they're basically like this. Hey, buy some of this debt. We'll pay 1%. You're like, no. Well, what if we give you 2%? No. What about 3%? I'm listening. Because what happens is you want to at least beat inflation. So if the government says, okay, remember the 1970s, okay, we will give you 10%, not the government, but other lenders, we'll give you 10% to 10% return? Shit, where do I sign up? Here's my money. Because that's crazy. Listen, junk bonds, like I told you, junk bonds pay between 4 and 5%. And those are for companies that have a 50% bankruptcy statistic, meaning 50% of the time they go bankrupt. So if junk bonds are paying 4.5 to 5, 4 to 5, and someone offers you 10 for government debt, well, one, you should go, whoa. Does that mean there's a 50% chance or greater that the government's going to be insolvent? Yeah, common sense will tell you that. But what it also means is there's some kind of fracture in the debt market. And so when those rates spiked, people were like, oh, hell yeah, that's a price I'll operate at. Well, the Fed came in, they buy every single thing. They buy the 10, the 20, they buy all of this long end debt to drop the price. What do they buy it with? Well, they buy it with coupons. They buy it with bank reserves that are not real money. And that gets into this weird contentious relationship between what is money, what isn't money, and when does non-money become real money. It's very tricky. The way you can break it up in your mind is there is base money that travels within the banking system only, coupons, right? Monopoly money. And then there is broad money that you and I trade to go buy eggs and t-shirts and cars and stuffs. We buy stuffs. The 3.5 death spiral zone is a line in the sand that they really can't go over for more than a few minutes. And the problem is, and of course, would the fallout be instantaneous? No, but the fallout would be devastating. And it's a spiral of insolvency and more insolvency and more insolvency. I want you to think of it in terms of just housing. George Gammon did a really good video that he almost did really well, but he failed to draw some conclusions in psychology. But it was a really good whiteboard video, and it basically explained that there's this spiral where the government prints more money through the Treasury. They sell more debt. They're actually, like Jeff Snyder will tell you, they're buying up. The Fed goes in and buys up the most liquid securities, which is stupid because it robs the market of good quality collateral, creating more collateral problems. That's what was 2007 through 12. Why do you think the big meltdown happened in August 2007? No quality collateral, bad collateral. It wasn't just you buying a house you couldn't afford or strippers buying 5 houses. It was a failure to provide quality collateral. And then when the Fed went in to bail everything out with fucking QE, they bought up the most liquid assets. They bought up the most quality collateral. They robbed the market that needed quality collateral of the most liquid, on the run, low time duration bills. They really don't know what the fuck they're doing. I mean, it isn't that the Fed barely doesn't know. They really don't understand what they're doing. And you don't have to be a genius to see this. You just have to look at the colored shit that I have on the screen here. So we're backed into a corner now where if the Treasury prints more money and it escapes into society, inflation expectations go up. And if expectations go up, yields rise because you're not willing to basically loan to the government. Well, if the inflation expectations go up and yields rise above 3.5%, the government and corporates can't roll over their debt. If they can't roll over their debt, there's some kind of insolvency event. Well, the government can't go insolvent, so they have to print more money. But if they print more money, well, then inflation expectations go up and rates go up and they can't roll over their debt. You see how this is a vicious cycle. Also, let's think of housing. You know, George Gammon did this real well. So if the rates go from 2%, 2.5% right now to 3.5%, 4, 5, 6, 7, 8, 10, 18, like in the 70s, do you think anyone is buying a new house? No. Because think about those of you that have a home, think about what your mortgage rate is. 1, 1.5%, 2, 2.5%. If that tripled, could you afford your mortgage payments? No. You get nuked, dude. You get freaking nuked. You are out. That means you're going to have to get out of that house, or you're going to have to cut all your bills or get rid of the car or something. You think this doesn't transcend over to the car market? What about autos? They start charging you 20% interest, 15 on a car. Is anybody buying any new car? Maybe high-end luxury. Why? Because super rich people are super rich. But barely rich people, they're not barely rich anymore. And so what happens is it guts the car market, the new car market. It's going to gut the housing market because now you have a bunch of people that can no longer afford their mortgages. They're out. What do you think that's going to do to prices? You know, the cure for high prices is high prices. So if mortgage rates go up and there's less buyers, it's just like the debt market. If there's less buyers, how do you entice them? Well, if yields are high, prices come down. Let's talk about that. That's important. Oh no, that's not what I meant to do. I meant to do this. Let's talk about time duration and what that looks like. Can you guys see that? Okay, time duration. Risk and yield, you can consider those together. Yield equals risk. Percentage rates, higher the percentage, higher the yield, higher the risk. They're all together. Yield and risk, just glob those together in your mind, are inverse, meaning they go the opposite direction of the price. Okay? So, as the prices of debt to buy that debt unit go up, yields go down. See? Here's how that works. As risk and yield increases, that'd be over here. As risk and yield go up, more risk, the price of debt goes down. But as risk goes up, yield goes up, right? Meaning the more risky behavior has to pay you more to own it, okay? But the price of that debt goes down, okay? As risk and yield decrease, okay, as the risk goes down, there's less risk, they don't have to pay you as high of yield. That makes sense, right? Let me make it where you can see both of these. Can you? Can I make it smaller? Oh, it won't let me. Okay, sorry. There is a way to do it. I'm just learning this. Anyway, so as risk and yield go down, as the risk goes down, the price of those debt instruments goes up. It's like a little seesaw, okay? As risk and yield go up, the price of the debt goes down, right? And it's just about enticing people into those markets. And then that gets us back to the curve again. Okay? So, the key takeaways. Healthy risk or yield curve. The longer you're in it, the longer you're loaning the government or a corporation your money, the more they're willing to pay you for that because of inflation expectations. These are all forward-looking, expectation-driven markets. Okay? The 3.5% line in the sand is the death zone where most corporations and the government itself literally cannot afford to roll over their debt without printing more currency units. And in the case of a corporation, when they can't roll over their debt, instead of buying their stock back with this little bullshit Ponzi scheme, guess what? They have to sell their stock. And when they start selling, what do you think happens to the price? Down, 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 down. So they sell, the price of the stock goes down. Guess what? Their debt gets downgraded. They get downgraded below triple B. Uh-oh. Pension funds can't own them anymore. Bye. There's a lot of other little details here, but this is just a basic overview. Mark, what's up, man? Doge Pound, what's up? So I guess I just want you guys to have a better understanding of how this works. So takeaways, healthy risk curve. When you hear getting pushed out further on the risk curve, they're saying that because the short-term maturities and debt are not paying anything, they want you to get out into the market, either with longer maturity debt or literally go out and invest in equities, go out and start businesses, take your money and put it out into society and get those animal spirits going and take risks. That's the risk curve. Why? Because they're saying there's no money to be made here. And if you're not beating inflation, here, we'll do another line. What color are we going to make the inflation line? Let's make it, I'll do it as a light gray line. We'll go line, yeah, okay, cool. So, okay, we have a light gray line at CPI. This is CPI. Well, that's a bad line, but you get it. Okay. Boop. See that line? That is CPI. Well, all of this stuff that's paying, 0.5%, 1%, if inflation is 2%, okay, then you're losing money. Everything under here is losing money. So what does that push you to do? It pushes you out on the yield curve. It pushes you out on the risk curve. It incentivizes animal spirits, risky, capitalist behavior. That's the idea. Oddly, the Fed thinks that by manipulating all of this shit right here at these low maturities, or by offering, various degrees of, medial interest on overnight reserves or on excess reserves, IOER, that will push people out. When you see very flat yield curves, manipulated or otherwise, and they are oversubscribed, meaning people are in that debt market, you have to think to yourself, wait a minute. Why are you willing to own government debt? If you know that they're printing, if you know that you're losing to inflation, why are you still willing to sit on this debt? And the reason is liquidity. So for a lot of companies, a lot of financial institutions, money markets, what have you, they're sitting on a bunch of cash, and sometimes losing a little makes more sense than going out into the market and investing. Matter of fact, most times. This is the interest rate fallacy, and I don't want to get into it too much, and I don't want to step on Jeff Snyder's toes, but essentially, when people think that having a good flat low yield curve is good, it's not. Because if people are hiding in government debt, that means they're not taking risk. They're hiding in very liquid but low return or negative return debt. That means they're not taking chances in the economy. They're not increasing production. They're not hiring new workers. They're not expanding their balance sheets with riskier assets. They're not participating in real expansion. They are fucking hiding in government debt. And that is the last place anybody should be hiding. Whew. Fun, right? So that was just a quick little talk. It's important. We'll do a quick look at prices just for a second. Oh, look at that. Bitcoin is up. Give it a few minutes and it changes right in front of your face. Ethereum is back over 1,500. ADA is, positive for the day. How about that? Theta. Oh, yeah. Theta is down. The token is down a little bit, but Theta just wasn't working today. The stream keys weren't working. Anything else notable? IOST is up 4% on the day. Bravo. Everything else is pretty flat, but they're starting to pick up some gains, a little bit of steam. So, if you don't like the markets, give it a few minutes. It's like Texas weather. Okay, I hope you guys liked this little look into government debt. I don't do whiteboard stuff a lot, but it's probably pretty important. If you understand the basic tenets of these markets, of the legacy markets, it makes it so much easier. I'm not a genius. I don't have 109,000 IQ like Leroy. But you know what I understand? I understand how these motherfucking markets work. And if you understand how these motherfucking markets work, then you see stuff forming in front of you that other people don't because they're simply too lazy to take a few minutes and understand the gears that turn the macro economy. It isn't enough to stare at crypto. You need to understand the legacy system. But once you do, man, trading gets a lot easier. And it seems like you have a crystal ball. Right? You feel like you have a crystal ball because in a sense you do, because most of the people in the crypto space, and I would even say a lot of the people in the big hedge fund space, they don't understand the basic gears that move the macro economy. And if you do, it is like you are in on a secret, which isn't even a secret. But I guess it's a secret to many because even the Fed doesn't understand how this stuff works, which is weird. Why? Because they use econometric mathematical models and they won't steer away from those because they're statistically Keynesian and they're not willing to have a come to Jesus and admit that their econometric models don't work in the real world. They work among other econometric models. Their math works inside their math equations. It doesn't apply to the real world because the real world is comprised of humans like you and I that trade based on psychology, not based on the Fed's econometric bullshit Keynesian garbage ass models. Okay. And on that note, we will get the party started over at Clubhouse. I apologize that Theta wasn't working. I don't have any control over Theta. I know you guys think I control the waters and the oceans. Yes, I do control the tides, but I don't control Theta. It's possible that they did some stuff with the stream keys. We'll figure it out. Okay. Don't do anything my poor insolvent drunk, strung out on meth, and buying government debt grandma wouldn't do. I hope you guys understand the debt markets a little bit better. You probably don't have it all knocked after this one little half-ass session with my scribbles, but you will. You will because you will practice, because you will get this, because it's important to understand this so that when you hear stupid stuff, you realize it's stupid and you realize it's noise and you have a lot more clarity. And on that note, I bid you a fawn. Did you? Let's go ahead and get this clubhouse room set up.